Hi, I'm Erlinda Doherty.
And I'm Robert Charetta, and this is International Investor. And for this purpose, we are going to take off our masks because Erlinda and I are trying to stay 6 feet apart in a very highly air-conditioned studio. So I think we'll be safe for this time period, even though we do try to carefully practice the PPE and CDC guidelines for safety. But Erlinda, this is a very special program for us.
It is indeed, Robert. This is our annual International Investors Global Economic Weather Forecast.
Indeed. This is the program that we produce each year to review the world's economies and forecast their future for the coming year.
Well, what a year this has been. With the COVID-19 ravaging throughout the world, it will be tougher than ever to highlight those nations that may exceed expectations in the coming year.
Or pose more risks than most people and investors even imagine.
Robert, I know International Investor has already focused 4 programs on the impact that COVID-19 is having on the world economies.
Indeed. With the help of experts in the past, we examined the cost to the U.S. economy and Europe, commercial real estate, and the work environment of the future. We even discussed the real and anticipated complications of mental health and some possible technical solutions to assist us in locating and killing the virus.
So in this program, we will offer our view of the likely impact on the world economies throughout the next year.
And even with the arrival of vaccines this year, we are still very cautious about the world recovery. We see economic weakness in many nations continuing for years to come.
Well, let's begin circumnavigating the globe. According to the World Bank and the IMF, the global economy suffered its biggest loss in 2020 since record-keeping began, a loss of 4% of the world's gross domestic output. But remarkably, Robert, they also expect a robust recovery of 5.2% in 2021.
That's because there's a wave of enthusiasm over the introduction of a series of new vaccines. But I think that should be guarded enthusiasm, given that we still might find ill effects from some of them as they are administered, and it will take quite some time to effectively distribute them throughout the world.
Even here in the U.S., the best estimate is that we inoculate 20 million Americans per month, starting with targeted groups. But with a population of 330 million, you can see why that may take a long time to immunize the majority of the people.
And in many surveys, it appears that only 50% of Americans are willing to receive the vaccine. So this will require a big public education effort.
And Robert, that's just the United States, because these vaccines require refrigeration and healthcare agencies to deliver the vaccine. We will find many, many nations that lack these resources or just don't have the transportation, electricity, and refrigeration to do it effectively. And their populations may even be more resistant than ours. It may have a long period of time until we can immunize a good portion of the world's populations.
But let's get back to the expectations for the economic recovery of the nations of the world. What strikes me as foolhardy on the part of the World Bank, IMF, and most of the Wall Street forecasting houses who expect a rapid recovery is that there's only one nation they can point to that will have significant positive growth next year.
China, where the IMF and World Bank expect a 6% plus growth in GDP in 2021.
But Erlinda, in our analysis, we differ from many of these forecasts because we note what these economists fail to do, that their crisis is not just existing in their own nation in isolation, but rather are often surrounded by neighbors who themselves are suffering from perhaps civil unrest, protests, border tensions, or even the threat of military conflict with other nations, which we believe will radically affect their economic recovery going forward.
And trade is an enormous factor for most economies in their recovery. Yet worldwide global trade was falling even before the coronavirus, and it contracted by almost 12% in 2020, the first loss in 30 years, and the worst downturn in trade since the Great Depression of the 1930s. Even next year, we will think trade will undergo an additional 4.6% loss, and the major exporting nations like China will feel this the most.
The World Bank, IMF, and most Wall Street firms are banking on a quick rebound in trade, but we think they are failing to account for a barrage of disruptions in the complicated supply chains of many manufacturers that will impact the distribution of their final products.
And then there is the collapse of tourism. Nations like Thailand, for example, rely on tourism for 10% of their GDP. And similar dependencies can be seen in other Asian nations, such as the Philippines, Cambodia, Indonesia, Vietnam, and Taiwan, and particularly island nations all across the world. And global tourism, such as the cruise industry and even international airline travel, will likely not recover for years to come.
And people will still avoid travel if 30 or 40% of the world is not yet immunized, and border controls will continue to be on high alert and reluctant to allow visitors, migrants, and tourists, which could trigger another wave of infection in their own nation. And as we pointed out many times in the past, the contagion effect of what is happening in your nearby trading partners and other neighbors can't help but affect your own nation and your own economy.
But Robert, in China, we see economists pointing to rising trends in industrial activity and production as a sign that China is emerging from its economic slowdown.
But if you look behind their official stats offered by their own government, their retail sales are actually flat. So while we see China continuing to manufacture goods and using up commodities, we believe much of it is just building up surplus inventories. And unlike the global financial crisis of 2008 and 9, this time China may not be able to buffer the world's economy as it continues to grow.
Yes, let's listen to the presentation of one China expert on how we might be disappointed this time around.
It's really only China that seems to have gotten back to where things were pre-pandemic. One issue relative to, say, the 2008-2009 global financial crisis, when again China was a key contributor to the global economic recovery, is that this time China is recovering in a slightly different way. In the aftermath of the 2008-2009 global financial crisis, China had a surge of credit-financed investment that boosted its economic growth, but also pulled along much of the rest of the world. China had a much greater demand for commodities, started sucking in imports from the rest of the world, so this helped a lot of other countries. Right now, and this may be good for medium-term growth in China, China is growing not just because of investment, but also because retail sales and private consumption more broadly have picked up as well. In addition, China has continued to be an export machine, largely because even though China is now more of a service sector economy than it used to be, it still relies to a great deal on manufacturing, and Chinese exports seem to be what the rest of the world wants as well. So China can't quite be relied upon to pull the rest of the world along quite as it did, so countries are going to have to rely on their own devices.
Interesting. You know, Erlinda, there was a new Chinese proverb born during the global financial crisis of 2008 and 9, focusing on the significant dates in Chinese 20th century history, beginning with Mao Zedong's military takeover of the nation in 1949. It went as follows. In 1949, China was saved by communism. In 1969, when Nixon met with Deng, China was saved by capitalism. In 1989, when the Soviet Union collapsed, they said communism was saved by China. And in 2009, they said capitalism was saved by China. According to our guest lecturer, this time around, China will not be saving the world economy.
And Robert, you and I both believe that rising social unrest, political and military tensions around the world will further hinder economic growth, and they could partially be attributed to the COVID-19 pandemic.
Yes, because we have noted a pickup in every category of social, political, and military unrest. And as we review the world's economies, we feel compelled to highlight those as well, because they will have immediate and long-term impacts on their economies.
Let's begin again with China. Despite glowing reports, China is embroiled in unrest, from the protest movement in Hong Kong to their military threats against Taiwan, to its ongoing strife with Tibet and Nepal, to its border violence with troops in India and Pakistan, and its treatment of the Uyghurs, and even difficulty with Mongolia.
And let's look at the rest of Asia. While the World Bank and IMF expect better results, we believe Asia on the whole will slip another 2.5% next year. Aside from the never-ending threats from North Korea, which is locked down even tighter to fight the coronavirus right now, South Korea and Japan may both experience a lackluster recovery at best to zero growth next year, if all goes smoothly and no further surprises from President Kim Jong-un. But India will fall another 9.8% as far as we're concerned, as the virus continues to ravage and build in their very urban populations.
And Robert, India's neighbor Bangladesh is having its own problems with social unrest as they try to absorb the Rohingya people who are fleeing still from the violent oppression in Myanmar.
That brings us to the Middle East and great numbers of disruptions and more unrest. Outgoing President Trump has told our military to withdraw troops from Afghanistan and Iraq, but because both governments we leave behind are very corrupt and unstable, we see the Taliban moving into Afghanistan, and Iraq's government will continue to be torn apart by widespread protests, which took the lives of over 600 people in the last 2 years.
But on the brighter side, Israel seems to be enjoying better relations with Saudi Arabia, the United Arab Emirates, and Bahrain, all signing peace deals at the urging of the Trump administration.
You mean at the bribing of the Trump administration? Who knows what it will cost the U.S. taxpayers when presidents make deals? And already the Saudi offer of peace seems to be falling apart because of the defeat of Donald Trump in the election, perhaps.
And after decades of relative peace between Israel, Turkey, and Greece, we now see turmoil among them over new finds of natural gas in the Mediterranean Sea floor between their nations.
And on the north side of the neighborhood, Syria's got a long recovery ahead following a 10-year proxy war between the West, Turkey, and Russia. And on the south side of the neighborhood, Yemen is still undergoing bombardment and suffers a terrible humanitarian crisis at the hands of the Saudi military aggression, whose weapons are supplied by the U.S. and the United Kingdom.
All this is showing up in the economies. The Middle East, North Africa, regions like this fell 6% GDP this year, and our expectations will be that it will fall another 4.5% next year.
Well, let's look at North Africa. For the first time in decades, we see nations such as Morocco and Algeria are beset by factions within who want to create civil war or disruption.
And don't forget Libya's ongoing civil war, which vacillates between warring factions every few months. And even the star of the Arab Spring, Tunisia, which had the best chance of supporting democratic government, is also suffering from political turmoil.
Well, further down the Horn of Africa, we see Ethiopia, the second most populous state in the African continent, and Eritrea are being pulled into military conflict by a rebel group in the Tigray region, slaughtering thousands and forcing over 25,000 people to flee to Sudan, which itself is in a continuing dispute with South Sudan, unless a peace deal can keep them at bay.
Much of sub-Saharan Africa continues to suffer from rebel insurrections such as Boko Haram in Nigeria, insurgent groups in the Central African Republic, and the Congo.
And the financial woes from these nations are being exacerbated by the COVID-19 virus, as nations such as South Africa to Zambia and Kenya fall victim to the spread. You know, Zambia just announced it would be defaulting on its sovereign debt, and others may soon follow.
Let's move now to the Caspian Sea and the stand states. Thousands of protesters showed up in the Georgian capital of Tbilisi last month, claiming that their presidential election was rigged and demanding another.
The stand states were one of the very few areas of the world that we were optimistic about last year, because many of them were connecting to the global economy for the first time, some via China's new Silk Road. But now we see political tensions rising in at least 3 of those states, and China and Russia are both trying to exert their influence on the outcomes.
Which moved us towards the Black Sea and Eastern Europe. The conflict in Ukraine continues, but it's complicated by the scourge of corruption in its government, which is the worst it's ever been. In eastern Ukraine, the government, supported by the US weapons, is fighting against a Russian population, which grew up there, supported by Russian military.
Russian and US support blows with the windmills of politics in both nations. And for the first time in decades, we see Armenia and Azerbaijan exchanging fire, and Azerbaijani troops killing scores of Armenians. A very fragile peace deal has been taken hold, but bad blood going back more than a century will make it doubtful that it will hold.
But Poland and Hungary are conflicted themselves, as they have become the outliers of the European Union. They don't seem to agree with Brussels with many issues such as immigration, social rights of minorities, or the treatment of the press.
You know, in previous years, there was a much greater concern about these right-wing parties. But with COVID-19 at the door, they have reinforced political support for their tough border controls. And they are pushing the EU hard for their autonomy, even vetoing the most recent EU budget.
And both Poland and Hungary seem to be enjoying warmer trade relations with the Russian Federation, which itself is weathering the COVID-19 storm with some degree of stability. Although its GDP fell 4.4% last year, it wasn't as bad as feared. And we see a recovery in 2021, which might draw to even if the price of oil recovers.
Yes, Erlinda, I have to laugh at economists who always underestimate Russia and some other nations on a regular basis. Even when they tell us things are terrible, you often visit these countries and find that most people are living quite well. Italy is another one that comes to mind. It's partly because these citizens have become amateur experts at hiding money and eluding the tax man. And all of Europe, to a large degree, will be even more reliant on Russian energy than ever before, with the Nordic 2 undersea pipeline about to be completed next year, bringing a vast supply of Russian natural gas to Germany and the rest of Europe. Western Europe grows increasingly closer to Russia, despite the cries of anguish from the Baltic states.
But Italy, Germany, Spain, and France had a terrible 2020 with repeated COVID-19 lockdowns and will continue to drive their economies downward,
including tourism and international travel.
And let's not forget what's happening as of December 31st, 2020.
Brexit. Erlinda, we've devoted several shows to Brexit, which shows it will hit the economy of Great Britain much harder than generally realized by most economists, and will open a flurry of disputes over such things as fishing rights with their Nordic neighbors, such as Norway and Sweden and Denmark, and even with France along the coast of Normandy.
And don't forget Portugal.
Now it's time to cross the Atlantic, so let's glide to South America.
Brazil was the second nation in the Western Hemisphere to report the COVID-19 virus, and even its president, Bolsonaro, was infected.
And there is political turmoil everywhere we turn, from Chile to Peru, to Bolivia, to Argentina, to Colombia and Venezuela, of course. The economic pressures are mounting.
And as if the virus wasn't bad enough, the nations of Central America were ravaged by several hurricanes, destroying much of their infrastructure and putting them in an extremely vulnerable position. Robert, we've already seen waves of immigration from these nations heading to the United States, and we will likely see new parades of people moving north again.
All of these migrations will be funneling through Mexico, which is now bordering on a narco state itself, with criminal drug cartels effectively controlling federal, state, and local governments. And this impacts our borders, as you know, Erlinda. with military-style weapons moving south from the U.S. into Mexico, and the drug trade, gangs, and their human trafficking moving north and throughout the United States.
Which brings us to the United States and our outlook for 2021. Many are hoping that with a new presidency, we are able to combat this virus more effectively and bring back some form of economic stabilization.
Oh, I wish I could be more optimistic, but from an economic perspective, I don't think Wall Street or anyone fully appreciates the severity of this crisis. You know, despite pledges of new help coming from Congress, we still expect 20% of the nation's small businesses to fail, leaving 30 or 40 million Americans facing long-term unemployment. And our medical bills are going to be soaring from this COVID-19 virus and subsequent illnesses, which may become chronic for many survivors, adding to the health care costs. The impacts on local, state, and federal budgets and their pensions are just beginning to be realized and calculated. Large-scale government layoffs will continue to be announced quietly as possible, as will those from the private sector. But bankruptcies and commercial real estate will collapse in many cities and small towns as bond issuers, developers, and real estate trusts become insolvent. Local banks will also feel the pain as a result. I believe that the nation will face its worst financial threat since the Great Depression, and one far worse than the global financial meltdown of 2008 and 9. The damage will become evident in 2021, and real recovery, the kind that begins to overcome that damage, won't even begin until 2022 and beyond.
Well, we have one final presenter who also believes that consumers will be impacted by this era for a long time to come. Let's listen to her now.
So even when we were at 3% unemployment, we knew that any shock was likely to hit, the second tier with increased severity. Now, we weren't expecting the size and the nature of the shock, which was a double whammy for vulnerable populations, right? Because they're clustered in hospitality and face-to-face service industries. So for the U.S., the hit has been regressive, right? And we've actually seen a reversal of the David Otter U-curve. In the last 9 months, we have seen a sharp contraction, over 8% of low-wage work. And many of these jobs are disappearing as a share of the work. So the worry is that these workers will become permanently unemployed.
Indeed. American consumers account for 68% of our gross domestic product, the dominant share of U.S. aggregate demand. But after plunging by an unprecedented 18% from January to April this last year, total consumer spending has since recouped about 85% of that loss in real terms. But the devil is in the details. The rebound has been concentrated in goods consumption. Those big ticket items such as cars, furniture, and appliances, plus soft good non-durables such as food, clothing, fuel, and pharmaceuticals that have been more than made up for what was lost during the lockdown-induced plunge. But a lot of that was pushed hard with heavily discounted items, cheap or zero credit for such things as car purchases, and a surge in online buying by stay-at-home, bored consumers. But the service sector of the economy, which makes up 61% of total U.S. consumer spending, is a different matter altogether. Services accounted for fully 17% of the collapse in total consumer spending from January to April. And while services have since partly rebounded, as of September, they've regrouped just 2/3 of their lockdown-induced losses from earlier in the year.
Robert, all those symptoms and negative impacts that you outline in the United States will play out in many, many other nations of the world, right?
Unfortunately, even with the arrival of the vaccines next year, we believe that the distribution at the start of 2021, people will still continue to be infected and perhaps reinfected well into 2022.
And your financial outlook must be equally depressing.
Yes, but like all things, there will be winners as well as losers. So for our discussion of the prospects for the U.S. economy, the financial markets here in the U.S. and around the world, stay tuned for our future report.
Well, to end a pretty tough year, this is Erlinda Doherty signing off for International Investor.
And this is Robert Sharetta. Goodbye, good luck, and in this case, stay safe. Because as we like to point out, you only have your freedom if you have your good health. One final comment for International Investor as well. It turns out that as many businesses, ours was also disrupted this year of 2020 as we saw the first 2/3 of our year lost to production because of the COVID-19 epidemic. It turns out that this very studio that we're in now will be also permanently closing this very month. So we will probably have an indefinite period of interruption in our production and a delay in getting started for 2021. However, I hope to see you all back then healthy and strong as International Investor hopes to get restarted in the coming year, and we will do our best to try to keep you alert and informed about what's happening in the global economy. Thanks, and again, stay safe, and we'll see you in 2021.